Imagine one morning you wake up to the news that banks are closed. You pick up your phone to check your balance, but the app won't open. A note has been posted on the ATM down the street. Out of service. Shops are open, but you can't use your bank card. Gas stations are operating on cash only. Rent is due, but your landlord won't accept a wire transfer. At first, you think it's a temporary glitch, but then you notice the chaos on the streets. People have formed long queues in front of closed bank branches. Supermarkets are full of customers paying with crumpled banknotes because the cards in your hand no longer work. You're following the latest news on television. The financial system has been placed under emergency review, and suddenly that thought hits you like ice to the face. Your money isn't where you thought it was. It's not sitting in your account ready to be withdrawn. It was always just numbers on a screen anyway, and that screen went dark when you least expected it. This may seem like a dystopian novel plot, but it's not. It happened before in very recent history, and not in some distant, unstable country. It happened in countries that consider themselves modern, secure, and protected. And when something like this happens, life doesn't slow down politely. It breaks suddenly and abruptly. The rules of wealth and survival change overnight. Let's take Argentina, the year 2001. After years of economic mismanagement, debt, and IMF bailout packages, the government was desperate. Banks were bleeding as citizens tried to convert pesos to dollars and flee the country. The government shut the doors. They called it corralito, a small enclosure. But for ordinary Argentinians, it was a cage. Cash withdrawals were limited to 250 pesos per week. Dollar-denominated accounts were forcibly converted to pesos at a devalued rate. In just a few weeks, savings accumulated for homes, businesses, or retirement lost half their real value. People banged pots and pans in the streets. Middle-class families who thought themselves secure and stable were suddenly plunged into chaos. This is what happens when banks close. Money evaporates, not in an abstract sense, but in a real-life sense, where bread, milk, and rent become unaffordable overnight. And Argentina is not alone. Cyprus, in 2011, as part of a bailout package, the European Union forced the government to freeze bank deposits. Ordinary depositors woke up to discover that accounts over 100,000 euros would be seized, literally confiscated to save failing banks. Those who felt this most weren't billionaires. It was businesses that suddenly couldn't pay employees, retirees who couldn't access their pensions, parents who couldn't cover their children's education expenses. In Lebanon in 2019, years of corruption and financial collapse triggered capital controls. Banks limited withdrawals to a few hundred per month, regardless of how much was in your account. Savers stormed branches not with documents, but with weapons. And in each of these cases, the story was the same. What you thought was your money was theirs. In the United States, those who say this could never happen had their banks closed too. In 1933, in the depths of the Great Depression, President Franklin Roosevelt declared a nationwide bank holiday. For 4 days, every single bank in the country closed its doors. Citizens couldn't withdraw cash. Businesses couldn't pay wages, and uncertainty reigned. Only after the government audited and selectively reopened banks was public confidence slowly rebuilt. But think about it. One of the richest countries in the world had to literally freeze the entire banking system to prevent collapse. The common thread in all these stories is this. Banks don't hold your money the way you think they do. They operate on a fractional reserve system. For every lira deposited, only a portion stays in the vault. The rest is lent out, turned into investments, converted into debt. When too many people demand cash at once, the illusion shatters. And instead of admitting the fragility, governments typically side with the banks. They freeze withdrawals. They devalue deposits. They make you pay the price for the mistakes of a flawed system. Now imagine this happening in your own city tomorrow. What would you do? Do you keep cash at home or with you for a week or a month? If the bank itself is the problem, can you pay your mortgage? If digital numbers disappear, can you feed your family? This isn't about paranoia. It's about facing the uncomfortable truth. The financial system wasn't built to protect you. It was built to protect itself. And when stress comes, you'll discover that banks aren't security vaults, but fragile trust machines. When that trust cracks, money and power start flowing in different directions beyond your control. That's the nightmare scenario. And as we've seen in countries that considered themselves too confident, From Argentina to Cyprus, Lebanon to the United States itself, this isn't hypothetical, it's history. And history has a nasty habit of repeating itself. When we scratch the surface of these crises, the pattern emerges painfully clearly. Banks don't collapse because of random chance. They collapse because of how they're built. Fractional reserve banking, the very core of our financial system, is both its genius and its Achilles heel. Put simply, banks don't sit on your deposits waiting for you to easily come and collect them. They take your money and multiply it. If you deposit 1,000 lira, the bank might keep 50 lira in reserve and lend out the rest to a business, a home buyer, the government itself. This credit, in turn, becomes someone else's deposit, which can then be lent out again. Out of nothing, 1,000 lira becomes 5,000 or 10,000 lira in circulating credit. This is a machine that feeds growth. But it's also a house of cards, because if too many people come asking for their money at once, the bank doesn't have it. That's why trust is everything. The system works as long as people believe the bank doors will stay open. But the moment trust shakes, a run begins. It doesn't take everyone demanding their money, just enough people to expose the thin layer of reserves. And when panic spreads, even solvent banks can fail. It's like a fire in a crowded theater. One scream or rush to the exit, and suddenly survival becomes a stampede. Governments know this. That's why in crisis after crisis, they don't act on instinct to protect the individual saver, but to protect the money in the banks. When Argentina implemented the corralito, it wasn't out of malice. They knew that if they let people keep withdrawing, the banks would collapse within a week. When Cyprus applied a haircut, seizing depositors' money to recapitalize the system, it was sold as bitter medicine. But the reality was brutal. Ordinary citizens were forced to assume the mistakes of politicians, bankers, and international creditors. In the United States, in 1933, Roosevelt wasn't just calming the public. He was buying time to stop a cascade of failures. The truth is, banks and governments are united. Banks need governments to enforce trust, guarantee deposits, and support them in crisis. Governments need banks to buy their bonds, finance their deficits, and channel credit into the economy. When stress comes, they close ranks, and the one left outside is you, the depositor, the taxpayer, the supposed owner of your money. The illusion is reinforced with rules and insurance schemes. Deposit insurance seems like protection. In America, the FDIC guarantees accounts up to $250,000. But ask yourself, if every depositor in the country rushed to claim this guarantee, would the money be there? No. The insurance fund is a fraction of deposits. Its real power is psychological. It's a strategy designed to keep you calm. And when banks close, what happens? Commerce grinds to a halt. Digital payments vanish. Wages are delayed. Supply chains lock up. In Lebanon, factories couldn't import raw materials because they couldn't transfer dollars abroad. In Greece, during the 2015 crisis, people waited in line for hours in scorching heat at ATMs to withdraw just 60 euros per day. Weddings were postponed, surgeries delayed, children pulled from school, all because the financial system decided that access to money was no longer a right, but a privilege. Even in the age of smartphones, crypto, and fintech apps, the problem hasn't disappeared. In fact, it has deepened. The digitization of money has made us more dependent than ever on banks and centralized systems. If the system crashes, the card reader fails. The institution freezes your account. Your wealth is suddenly nothing more than numbers in limbo. In a cashless society, the idea of a bank closure isn't some old fear from the Great Depression. It's a modern nightmare waiting to happen. Now think about the ripple effects. Businesses can't pay workers, so layoffs multiply. Supermarkets can't pay suppliers, so shelves empty. Investors panic, selling assets at fire sale prices, depleting retirement accounts and pensions. The government struggles to restore confidence. But each day, the queues get longer and patience runs out. What starts as a technical decision in a boardroom becomes a full-blown social crisis. And the longer it lasts, the more desperate people become. Barter, hoarding, even riots begin. This isn't theoretical. It's happened in countries around the world. It can happen again. And if you think it could never happen in America, Britain, or Germany, remember that these were exactly the same words said in Argentina in 2000, Greece in 2010, Lebanon in 2018. Stability is an illusion until the day it's not. The uncomfortable truth is this: banks don't exist primarily to protect your wealth. They exist to protect themselves and the system they serve. When stress comes, they'll sacrifice you to survive. The system is built this way, and to claim otherwise is the most dangerous mistake of nations. Imagine tomorrow morning you wake up to find your bank's website offline, your debit card declined, and your paycheck indefinitely delayed. Now extend this beyond a day or two. What if the closure lasted weeks? If payroll systems are frozen, can your employer pay you? This is where fiction merges with terrifying reality. Banks are not neutral vaults. They are the arteries of the economy. Cut them, and everything downstream starts to die. The lessons of past crises haven't stayed on dusty history shelves, they're warning us. When Argentina closed its banks in 2001, the rage in the streets wasn't just about money. It was about betrayal. Ordinary people felt like hostages to a system they couldn't trust. In Cyprus in 2013, middle-class savers watched decades of careful work evaporate overnight to bail out institutions deemed too big to fail. In Lebanon, the collapse shattered the very idea of citizenship when people realized their leaders had gambled away their futures. And in the United States, during the Great Crisis, it forced an entire generation into lifelong saving habits. The same unsettling truth connects all these stories. Your money is only yours as long as the system says it is. It feels safe until it's just a number on a banking app. And that's why the lesson for today is so critical. In a world of record government debt, fragile global supply chains, and rising geopolitical tensions, the idea of a bank holiday or capital controls isn't remote. It's a tool in the state's arsenal. So what can you do? No, the answer isn't to panic withdraw or stash cash under the mattress. History shows that reactive fear only makes you more vulnerable. The real strategy comes through resilience. Diversification isn't a buzzword. It's survival. Owning assets in multiple forms, in multiple institutions, even in multiple countries can mean the difference between paralysis and mobility. True wealth isn't just what you earn, but what you can actually access in a crisis. Gold, real estate, alternative stores of value, even cash reserves. These aren't old-fashioned ideas. They're life rafts. And beyond the individual, there's the collective. We must recognize how laws are written. Governments appear to protect their citizens, but in reality, design financial protections that protect the system. Deposit insurance, emergency powers, capital controls. These are ways to manage panic, not prevent collapse. If we don't understand this, we become complacent. If we do, we can push for better rules, transparency, and accountability in a system that has repeatedly proven it protects itself before us. The chilling part of this story is how truly fragile trust is. Banks don't need to physically collapse. People just need to stop believing. The moment that belief cracks, the countdown begins. And when a closure is declared, the mask falls. Banks were never neutral, never just service providers. Their power structure is deeply connected to governments, corporations, and global markets. You're not a customer. You're a participant in a system that works until it doesn't. History doesn't repeat exactly, but its echoes are heard loudly. The lesson from Argentina, Cyprus, Lebanon, Greece, and the United States is simple. Don't confuse access with ownership. If your wealth is solely at the mercy of institutions, it isn't truly yours. To build financial freedom, you must look beyond the illusion of security and prepare for the moments when the system stumbles. Because one day the question might not be, what if the banks close tomorrow? But rather, they've already closed. What do I do now? See you next time.